We are always there for Japan. That is how the US president explained the fast joint yen rescue since 1998. What he did not mention, Japan is the largest foreign holder of American debt. And defending the yen means selling it. Welcome back, everyone. I'm Kirill Salai, investment analyst with over a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for a portfolio. Today, I have two things to discuss. The first one, the United States and Japan stepped into the currency market together and bought yen. A combined intervention, a rare event. Let's discuss the mechanics, why Washington joined, and what this tells us about the new regime the markets are entering. And the second story is a quick health check on everything else: the business cycle, the earnings season, and the market itself, including the two things that still keep me careful. Let's dive in. Back in late May, in the Outlook episode for the second half of this year, I told you that dollar-yen was sitting at an extremely important level. The yen was at one of its weakest points in decades. The pair was around 159, and my view was that the path from there should be toward 140, because the government has been protecting that 160 level for some time. Although the yen did not strengthen from 159, it weakened further all the way to nearly 164, the weakest level in roughly 40 years. The Japanese authorities have eventually stepped in size and choreographed with Washington, exactly as we discussed. Quick disclaimer, nothing on this channel is financial advice. I'm sharing my views and analysis, but you always do your own research. First, why intervene at all? Here's the loop Japan is stuck in. The Japanese authorities have been trying to revive the economy. The government has been spending a lot, but that results in slowly rising inflation. Now at 1.9%. Sounds low, but not for Japan. In February, inflation was 1.3%. So the market is getting worried about the pace of interest rate hikes, finds that it is not enough. And therefore, the yen has been weakening. And here is the problem. The weaker the yen gets, the more Japan pays for energy, food, and everything it imports. So the weak yen makes the inflation problem worse, which makes the too slow central bank look even further behind, which weakens the yen again. But the government already has a high level of debt. So the central bank cannot really increase rates that much, because then the interest expense on the debt will skyrocket. So this is a loop that needs to be broken. And by the way, after this intervention, the Bank of Japan met on Friday and did not increase rates. Very counterintuitive, unless you look at through the lenses I just described. So, what actually happened? On Thursday, the yen hit 163.7 per dollar, and Tokyo reportedly began intervening during New York trading sessions. On Friday came the main event. Japan and the United States bought yen together, aggressively. And on Monday, both governments confirmed it publicly and, by all indications, did it again. The yen went from nearly 164 to around 155 at the strongest point, a move of almost 4% in 2 sessions. Significant for a reserve currency. How big was it? The official number only gets published at month end, but the estimates based on Bank of Japan accounts point to tens of billions of dollars in a single session, with some estimates for the full operation approaching $100 billion. Japan intervening alone, we have seen that in 2022 and then in 2024, business as usual. The two governments acting together, That last happened in 2011, after the earthquake. They sold the yen, which was too strong, and jointly buying yen to strengthen it. You have to go back to 1998, the financial crisis in Asia. So that happens roughly once in a generation. So why did the United States join? President Trump framed it simply. Japan is a friend, they had a weakening yen, they wanted a little bit of help, and America is always there for Japan. The relationship genuinely has been excellent, it's true. But friendship is not the full story here. The United States is an involved party. Here's how a classic intervention works. Japan's war chest is not sitting in cash, it's sitting mostly in US treasuries, roughly $1.1 trillion of them, which makes Japan the largest foreign holder of American government debt. To defend the yen, Japan first sells treasuries to raise dollars and then sells those dollars to buy yen, which means a large yen defense is, mechanically, a large sell program in US government bonds. And look at where the US long end already trades. The 10-year is around its highest level since January. The 30-year is above 5%. The last thing Washington needs, while it runs trillion-dollar deficits and refinances a mountain of debt, is its single largest foreign creditor dumping treasuries into fragile long end. That is the real reason the US is at the table. So Japan did not sell the treasuries. Instead, the Bank of Japan used the facility at the Federal Reserve called FIMA, a repo window for foreign central banks. Japan pledges its treasury holdings at the Fed as collateral and receives dollars against them. Then it sells those dollars and buys yen. The treasuries never touch the open market. Beautiful. US government debt is not sold, so the long end is protected. Fresh dollars flow into the system and get sold for yen. So the dollar softens and the yen strengthens. Everyone wins. Now, is this over? Japan's finance minister said on Monday, we will not hesitate conducting further coordinated intervention. And the US Treasury Secretary went further. He publicly recommended that the Federal Reserve expand the FIMA facility itself, calling it an important safeguard and saying the expansion should happen within the next few months. The facility currently allows $60 billion per counterparty, and he wants the ceiling raised so that Japan can do more of this. The US Treasury is asking the US Central Bank to build bigger infrastructure for foreign governments to manage their currencies against the dollar. This is being institutionalized because other countries which might experience weakening of their currency will also try to sell US government debt to get dollars. The US clearly does not want that to happen. So, what is the real message here? This is the part that matters beyond dollar-yen. The authorities have just shown us that they do not want volatility in foreign exchange. And they do not want volatility in interest rates. Those are the two prices everything else in the global system hangs off. When those prices move in a disorderly way, the government will get involved. I would call this new regime volatility control. In spirit, it is not far from quantitative easing. The state stepping into markets to suppress a price move it does not like. But there is one enormous difference. Quantitative easing was run by central banks, independent on their own mandate. This is being run by treasuries. The US Treasury Secretary is appointed by the president. Monetary firepower is migrating into political hands. No moral judgment here, but you need to position for the world as it is. The state is now an active participant in the two most important markets on the planet, with a preference for coal. And the immediate trade consequence is the one we laid out in the outlook. The dollar is going lower against yen, and the broader dollar index is falling too. And in my view, that continues. So let's move to the second story. Quick pause. Headlines are designed to scare you. This channel is designed to unpack them. The mechanics, the incentives, what is actually going on. If you want that every week, subscribe. Okay, story 2, a quick health check on everything else, because the economy just delivered one of the strongest weeks of data this year. Start with the business cycle. The ISM Manufacturing Index for July, published on Monday, 55.6 against 54 expected. A huge beat. The highest reading since May 2022. And the 7th straight month of expansion. The components are also great. New orders at 56.7, production at a near 5-year high, and employment crossed into expansion for the first time after 33 consecutive months of contraction. So the cycle continues. Then the earnings season, with 61% of the S&P 500 reported, earnings are growing at 47% year over year, the best quarter since 2021. That number is inflated by two one-off surprises at Alphabet and Amazon, mostly their stakes in AI labs being marked up. Strip both out, and the index is still growing earnings at 29%. 86% of companies are beating on earnings, 77% are beating on sales, and revenues are growing 14% this quarter. Last episode, I walked you through Google's earnings and the insane order book they have. The question was whether the rest of the hyperscalers would confirm it, and they did. Microsoft Azure grew 43%, accelerating from 40, crossed $100 billion in annual revenue for the first time, and management guided the next quarter even faster. Amazon AWS grew 37%, the fastest in years, the 5th straight quarter of acceleration. And most important, AWS margins came in at 39%, up 6.5 points from a year ago. The cloud business is getting more profitable, while the CapEx rises. So the return on investment concern is fading. The market noticed hyperscaler shares rebounded, and on Monday, Amazon crossed $3 trillion of market value for the first time. Only the 5th company in history to do it. The chip makers rebounded too, and hard. Late last week and into Tuesday, the leverage unwind story you have seen everywhere by now, so I'm not going to retell it, but once that mechanical selling pressure was gone, the semiconductor complex snapped back. The S&P finished July flat, roughly, despite the volatility, and has been sharply rebounding first days of August. So overall, the market looks all right. But two things keep me from getting comfortable. First, the one I have flagged before, implied correlation. It is still sitting around 6, near the lowest reading ever recorded. This is the market's complacency gauge. Index level calm, while everything underneath trades on its own story. And notice, the last time this gauge was pinned this low, in the summer of 2024. What broke the calm was the yen intervention. So, and the history of Japanese interventions themselves, they tend to be followed by more volatility in risk assets. And the current operation is likely not finished. So some near-term turbulence would not surprise me. One more thing on the risk map. The Iran conflict, not resolved, of course, but from a market perspective, it is no longer in the acute phase. This second wave of escalation, as I said a couple of episodes ago, has simply not been able to move oil the way the first one did in March and April. All right, a quick look at the scoreboard. No changes. We grew a little bit relative to last week. So, put the two stories together. The state will suppress volatility in the prices that matter. The cycle is accelerating. The earnings are the best in 5 years. The cloud is getting more profitable, and the forced seller is out of the market. Against that, August and September are historically the weakest stretch of the year, and the complacency gauge is on the floor. If that seasonal volatility shows up over the next 2 months, I would treat it as an opportunity. For those sitting on the sidelines waiting for an entry into the chip makers, a shakeout in the weeks ahead is the window. I am looking to add myself. And on that, over the next few episodes, I'm going to devote a full episode to the AI trade and how to come back into it. Which sectors, which companies, in what order. That's it, guys. If this was useful, like the video and subscribe. It genuinely helps the channel. And I will see you next week.